Nick, jump in here. I wanted to ask Todd about where we're going in the ETF business right now. The S&P 500 at an historic high. We have had huge inflows this year into ETFs. We might have a $1 trillion year inflow, biggest ever. We got 10 trillion in assets under management. I want to get your thoughts on this rally. We've had a great move up in all of these cyclical sectors. Consumer discretionary is at a new high. Industrial stocks are a new high. Material stocks at a new high. Interest rate sensitive sectors like REITs and utilities are near new highs. This is not the kind of stuff that is at a new high if investors think the economy is going into a serious downturn. That's why I'm still relatively bullish. Nobody's going to be buying this stuff if they think there's an imminent downturn.
You think you have to be? I love the idea of going back the last few years and remembering anything that was not tech has been in a bear market since late 2021, early 2022, right? And that's a lot of these cyclical sectors that are finally moving. You haven't seen many inflows to these sector ETFs, which I really am a fan of because that tells me positioning is not too aggressive. And until I start to see staples outperform and credit spreads widening, right, real simple stuff, it does not mean, as you just said, it doesn't mean that the market is worried about any economic undertones yet.
And we saw staples do a little better early on, but now they're being overtaken. So consumer staples have been lagging recently. Healthcare's been lagging. Energy's lagging, but tech's also lagging a little bit, and nobody seems overly worried. It's not lagging much.
Yeah.
But nobody seems ever. There's a little bit of a correction in semiconductors going on, but it's not dramatic.
Yeah, the key part being it's a change in leadership, that financials are leading, real estate's leading. Tech is now leaving that leadership frontier. I'm okay if tech takes a back seat in terms of leading, as long as it doesn't start to go down. That's the big difference, right? It can rise with the rest of the market and not be a leader. That's totally fine. It's when that influential weight declines as the rest of the market goes up, they may get some sort of problem going down into 2025.
Nick, you've been in this business a long time. Give us, and you're head of ETFs at Janus, give us your thoughts on what you think is going on here. Do you agree with our point here? The market seems to be interested in cyclicals. That seems to be supportive of at least a soft landing in the economy. But your thoughts on what we're doing this year?
Well, I mean, the part of this that is amazing to me, I mean, obviously we just had a pretty significant rate cut for the first time in a long time. And it's interesting to me to see that when, we're hitting all-time highs, there's a conversation about what does that mean for ETF adoption. When the markets sell off, we have similar commentary about what does that mean for ETF adoption. When rates are declining, when rates are being, rising, it seems that no matter what the kind of macroeconomic drivers are, there's always an explanation for why that's going to feed ETF growth. And the reason is because it seems to. We seem to just be in a situation where kind of regardless of market conditions, we just continue to see this exodus from traditional fund assets into the ETF wrapper. And that to me is, really we've kind of hit the tipping point in the last couple of years where it's almost just regardless of what's going on. And there was a comment made earlier about the generational aspects of that. And I think that's true, right? We just are at a place where younger investors overwhelmingly prefer ETFs. Maybe in another 10 years, they're going to overwhelmingly prefer, blockchain delivery, but today it certainly is ETFs.
He's got a point, win or lose. It's sort of like win or lose. You still get inflows into ETFs.
Yeah.
Weak year, you'll get inflows into certain other sectors, but there's still overall inflows.
It's broad-based because of what fixed income is doing, because of what synthetic income is doing, leverage, right? All these as our friend Eric Balchunas calls them, hot sauce ETFs, right? That's contributing. Equities have been strong, but so is everything else.
Yeah. On top of that, international's not getting much love this year, but there's a small group of international ETFs at new highs. Mr. Modi, the Prime Minister of India, was in New York recently meeting with tech executives. So the India ETF is at a new high there. That's several different ways. INDA is the biggest one, I believe, that's out there. That market's at a new high. I see Singapore's at a new high, South Africa, Thailand, sort of a disparate group. And the Vanguard Emerging Market ETF, surprisingly, at a new high.
So India has been a beneficiary of the blow up in China, right? 32 years, 0% return, immense volatility. Investors have finally decided, I've had enough, which maybe that means it's the bottom for Chinese equities. But India has now taken that huge weight disparity and evened it out with China in the emerging markets ETFs. And it's a new growth play. It's simply put a growth play. There's plenty of tech there. There's plenty of consumer discretionary to get involved. The cyclical type of environment that investors are attracted to while China figures out whatever.
Yeah, and there's all sorts of debate about whether India really can replace China. Given how advanced China's infrastructure is, India is still relatively primitive, and yet the market doesn't seem to have any problems throwing money in it.
There. I think that's also a derivative of reshoring, right? Manufacturing moving out of China, and they're going to India where companies can now build that up. And the idea being that that market can benefit from it.
Yeah, there's an avalanche of cash going into fixed income as well. Fixed income is getting inflows. As the cutting cycle progresses, you might think, why so much money going into fixed income with the cutting cycle? Well, money markets fund, the futures market says money market's going to have a 3% handle. Now, I know some of you are getting 5% right now, but next year, it seems they're anticipating 3%, yet the money's very sticky.
The $6 trillion, of which $2.5 trillion is in retail money market accounts, is the most fascinating psychological experiment in this industry right now, because that 5% is going to evaporate real fast if the pace of cuts continues. And so I think a lot of that retail money is going to go to fixed income ETFs, because there's over 700 fixed income ETFs now. You can get any sort of yield, duration, credit risk you want, as opposed to, say, the cutting cycle in 2019, there were only about 300. And go back, there was less and less ETFs. So investors can get the product they want with very high precision, and so I think they're going to be a huge beneficiary. And you also have to remember, the ag has been in a bear market for 4 years, so a lot of investors tax loss harvested out of mutual funds, and it's all going to fixed income ETFs.
The ag being the general bond fund, the largest bond. Right. It's actually an index.
The benchmark that bond investors use.
Yeah,
the aggregate.
Just want to be careful about the jargon. The viewers don't know all the jargon about that. Nick, give us your thoughts on inflows into fixed income. He's right. It is a fascinating psychological experiment. $6 trillion in money market funds. I can tell you for sure, the viewers are delighted with 5% yield on money market. If it stayed anywhere near, a lot of them would stay there forever and be perfectly happy, because they can smell they're getting, and I think it's fair to say, an inflation-adjusted positive return on that. And yet it seems like that's not going to last. Like I said, they're expecting within a year to be in the 3% range. Your thoughts on this?
I mean, I think this is a really, really interesting test case over the next couple of years, like you said, for investor psychology. You know, $6 trillion in money market funds is an enormous number. People kind of fled there because of the rate situation. But I think there's a kind of a consensus that as rates come down, they'll just leave as quickly. And I'm not sure that that's true. People got really used to 0% yields. And so while they're not going to get 5 or 6% for very long, 3% I think is still going to sound pretty good to people. You know, it's interesting. We have benefited, I think, from the desire for investors to reduce duration over the last couple of years. We have the largest CLO product in the market. It's $12 billion in a AAA CLO product, and a lot of that money is from professional investors who are looking for yield in excess of money markets. And in the last week, 2 weeks, 3 weeks, as people knew rate cuts were coming and then they came, we've continued to see very strong inflows into that product. And if it was just about duration, I don't know that that would be the case. Now, it's yielding better than money markets, right? So people are definitely looking for extra yield, but I'm not sure that investors broadly, and particularly retail investors, are going to make a duration call as much as they want to ensure that they have adequate yields. And I think for a lot of people, 3% is going to feel pretty good for a while. So I definitely agree that the professional investor is going to start moving more and more into fixed income. And like every other cycle, when they go from money markets back to fixed income, they're probably going to pick an ETF over a mutual fund. But I have a feeling that the money sitting in money market funds, particularly retail, is likely to be stickier than people really expect.
Yeah, I completely agree. I could just tell you the email I get, even conversing with my mother, who's 95 years old, they just love it. And they feel it's a very good ballast to the stock market. They don't want the added risk. They're very comfortable. I've heard people have 10%, 20%, 30% in money market funds. Seems pretty high to me, but they don't. The volatility for particularly the older demographic, that's the ones that tend to write to me, tend to say, I'm very comfortable here at this particular level. I think you're right, Nick. I think it's much more stickier than people think. And so in a sense, everybody's waiting for, are we going to get $1 trillion of that $6 trillion going to the stock market? They may be wrong on this.
I think you need a big bear market before it goes into stocks.
Yeah.
Right, like in 07, 2000, that's what happened then. I'm not so sure about it right now.
Yeah, I think so too. All right, fascinating discussion, everybody. I know we've moved around a little bit, but that's what you get when you get two great guys like we had today.